Hey guys, welcome back to my channel, Invest and Travel. I hope you guys are doing great. I hope you guys make some money over the week. The stock did okay last week. I mean, overall it ended up negative for the week, but it wasn't that bad. Today I want to talk about a trade that I did on Thursday afternoon before the close of the market. So on Thursday there was quite a few earnings report, but I chose one to trade. The stock symbol name was PANW, Palo Alto. It is a security network company. Price of the stock was about 155 before the report of the earnings. So technically, I don't have any ideas which direction it's gonna go after the report came out. I don't know if it's gonna go up. I had no idea if it was gonna go up or down. Honestly, I could do so much research. I could do so much technical analysis and fundamental analysis, but still, earnings report is something different. The company may provided a really nice report, but the next day a lot of things can change that outcome. For example, let's say Palo Alto may deliver a awesome earnings, but the next day if the market is really bad, it could drag the stock down. Or if some news come out the next day that may impact the stock, it could also drag the stock down. And also, even if the stock deliver a really nice report, but they provide a really bad guidance for the next quarter, that could drag the stock down as well. So it's very hard. It's almost unpredictable. It's almost impossible to find out which direction the stock will go exactly. It could go up like in the morning pre-market, and when the market actually open, it could go the other way. So I never play one direction because I don't want to take risks. I mean, you don't want to bet against the market all the time. All right, so how would you trade Palo Alto in this case? So what I did, I executed a strangle strategy. I'm sure a lot of you know what is a strangle, but if you don't, I'll briefly go over it. Strangle is a strategy where you buy a call and you buy a put at the same expiration with different strike. All right, before the report came out, Palo Alto price was 155. I bought a call with the strike at 166 and a put strike at 146. So roughly about $10 on each side. So why did I bought $10 on each side? What if it didn't go up $10 or it didn't go down $10? Then I'll lose. Here's the thing, sometimes there are certain trades that you have to take a risk, but the risk is calculated into many different factors. So for a stock like Palo Alto, I mean, it's $155. Usually on the day of the earnings, it will move significantly a lot more than on a normal regular day. And I look back during the past quarters that Palo Alto delivered. They always move $10 or more, and because of that, I took a calculated risk. It doesn't mean this time or next time Palo Alto will move $10 or more. It could move $5, it could move $2. It may not even move at all. So but I still took a risk because based on every factor, based on all the research that I did, I was very confident that Palo Alto will move at least $10 or more. So by doing a strangle trade, if Palo Alto went up more than $10 or went down more than $10, I still make money either way. Shortly after I bought it, the earnings report came out and Palo Alto did really well. It went from 155 to 170. So that's more than $10. That's like $15. And the following day when the market opened, it's actually open at 171. Immediately I sold it because I didn't want to wait. I mean, if I wait longer, it may go up more, but it may could go down again. So which it did. It went all the way up to 172 and then it dropped back down to 169. But as soon as the market opened, I clicked sold and everything settled right away. From the screen, you can see the profit that I made. It's not a huge profit, but it was in a really nice calculated risk with a high probability of winning. So that's exactly why I took the Stranglers strategy. And there are plenty of other strategies that you can utilize, you can use for this stock before the ER. But I chose Strangler because it's easy, it's very profitable. It didn't cost much. It cost me a total of $495 for both sides. A little bit more than what I want to spend, but that was the cost of the premium, so that's exactly what I had to pay. Also, let me remind you guys that don't ever use that much money when it comes to trading ER, because if you lose, you can never gain it back. It's not like buying a share. If you buy a share, if the stock go against you, you can always wait for it to go back up, or you can sell call in the meantime while waiting. But with ER trade, there's nothing you can do. The next day, if the report comes out and you lose, you lose. So don't ever spend that much money on each of the ER trade. All right, spend what you can afford to lose only. Okay. Any other strategy and you want to discuss with me, you can comment below, and then we can discuss it together. All right, so if you like the video, if you like what you saw so far, please subscribe to my channel if you haven't, or click like and share with others so we all can benefit from it. All right, and until next time, I'll see you on the next video. Thanks for watching.